This is Natalie Pace, and I want to thank you for joining me today. Our video conference today is about the contraction that just happened in the first quarter of 2025. So the economy contracted just a little bit. And of course, we're being told, hey, don't worry about it. It was a one-time thing. And indeed, it was because we had a lot of imports and people were trying to buy before the tariffs kicked in. However, there could be more to the story than you might know. JP Morgan is predicting 60% chance of a recession this year. So who do you believe? Who do you trust? What do you do? Right? And even those paper losses that you're saying, people are saying, hey, don't worry so much about them. Are they more problematic than you know? And should you learn a strategy that maybe avoided the paper losses in the first place and actually protects wealth in downturns and outperforms the bull markets in between and is easy as a pie chart, which is why we call it the life math that we all should have received in high school? We're going to cover all this and more in today's video conference. So again, share with your friends. It's absolutely free. YouTube.com/Natalie Pace. And if you're coming back, and of course it may be more difficult to find if you're coming back a few months from now, just email info@nataliepace.com and say, hey, I want to check out that video conference where she talked about the first quarter contraction. All right, I'll be starting in just a moment. See you then. Okay, let's get started. Here we go. Start with our PowerPoint presentation. So we're going to be talking about risk return, paper losses, fees. And one interesting thing that a lot of people are not aware of is that the safest investments might be offering the highest return. So the economy contracted in the first quarter of 2025. It was just a little bit. It was mostly due to a massive amount of imports. We also had more in investment spending. Both of these things were very tied to people trying to get ahead of the tariffs. Now, that is why the economists are saying, okay, it's just a one-time event, but the economy isn't expected to grow that strongly this year in the best case scenario. And in the worst case scenario, if what JP Morgan says has a 60% likelihood of happening, which is the recession, of course, the economy contracts. And that's why it's important for us to have a plan that can work whether or not the economy weakens and stocks drop or stays okay, strong. 1.7% isn't really strong. It's just not weak. It's not, contracting. You need a plan that can actually make money when stocks go up, but also protect you from losses. And this plan is really important as we get closer to retirement. Now, I had an interesting question because I did a presentation yesterday on the Money Show, and someone said, hey, don't you think people are just going to get used to all these market gyrations and not worry about them and just sit on their hands and that sort of thing? And my response to that is this: it is impossible to ignore when you lose a great deal of money. And the sad truth is that most people wait until they lose a great deal of money until they get off their hands. Like they're saying, okay, it's just going to come back. It's just going to come back. And they're, maybe their financial partner saying, hey, just wait. And then at the market bottom, when they absolutely think we're in the apocalypse and they've lost maybe half of their wealth, which sadly is what happened in the Great Recession and the dot-com recession, people lost almost 40% of their wealth in the pandemic in 1 month. So these kinds of things are not things that we get used to. And the sad truth is the hedge funds and institutional investors, in other words, the whales of Wall Street, are the ones that are moving first. And Main Street is the one that's waiting. And it is usually the Main Street. First of all, you aren't going to get a notice that we're in a recession until at least 7 months after it's been happening. There are reasons for that because we can't declare it a recession until we have 2 quarters of contraction. We had 1 quarter. The next quarter is not expected to contract so far. We'll see if that changes. So right now, we're not expecting a recession yet, although, of course, people have said that there is a likelihood. So the interesting thing here is that no, people don't get accustomed because your life changes when you lose half of your wealth. Your FICO score plunges. You may be in trouble on a lot of things. You don't have resources to help solve problems. It's a big deal. And again, as the closer you get to retirement, the less likely you're going to be able to deal with this in a way that doesn't substantially change your life. And that is why it's important to have a time-proven plan before the downturn. Now, people say, oh, the market's always come back, but it took about 6 years for the Dow Jones Industrial Average to crawl back to even from the low in March of 2009. It took 15 years for the NASDAQ Composite Index to crawl back to even after the dot-com crash. So it's important to have a time-proven, well-diversified plan. Again, it's easy as a pie chart, that plan is. We're going to talk a little bit more about that. But I wanted to address upfront why you should even be watching this at all. And that is, A, yes, you do need to have a plan that works against downturn. And B, it's easier than you know. And the sooner you get it, the faster you can sleep more easily at night and protect your wealth and also grow it at an above average rate. Okay, so in 2022, we had 2 quarters of contraction. We had the first and the second quarter. They did not call it a recession, but we did see a huge downturn in stocks. Stocks dropped, the S&P 500 dropped 19.44%. Some of the Magnificent Seven dropped way, way more than that. So of course, if you didn't, you might say, well, what is the Magnificent Seven? These are all things that you should start learning because you're hearing about them, right? They're just the biggest technology companies on Wall Street, the trillion-dollar companies. They dropped the most in 2022. They gained the most in 2023 and 2024. And you might say, oh my goodness, that's too much to be keeping track of. It's actually easy as a pie chart. All you have to do is rebalance it once a year. If you have invested in something that has gone very high, even Bitcoin did great in 2023 and 2024, terrible in 2022. We'll look at that again. And again, in our pie chart system, when you have one slice of Bitcoin or Magnificent Seven, and it becomes 4 slices, or in the case of Bitcoin, it might become 6 slices, it's screaming at you, sell high, capture those gains, let your pie chart get bigger, let your wealth get bigger, but keep it. Don't just have it be on this wild roller coaster. So it's not difficult. And the pie chart system actually helps to put your emotions on the right side of the trade too, pointing you in the right direction. So one other thing that's really relevant for what we wanted to talk about today about keeping enough safe, and how do you keep enough safe when so many people that have money on the safe side that experiencing paper losses. And what we're seeing here, this is the why, right? In 2022, stocks, the S&P 500 minus 19.44, bonds, long-term government bonds lost even more. They lost 26%. So what that means, that was part of the reason why we had 5 banks fail in early 2023. So you might say, well, how do I know how to avoid that? I'm going to give you the cliff notes right now, and then we'll talk more about it. Keep the terms short and the creditworthiness high. You'll notice that the 26% losses were in long-term government bonds, long-term, 30-year. What do I mean by short-term? 2 years. What do I mean by creditworthiness? Well, the US is a AA plus rated country. That's pretty good. But did you know that over half of the S&P 500 companies are at or near junk bond status? That's the lowest rung of investment grade before it becomes speculative or junk. So be cognizant of that. And again, if you don't know this, that is why we offer our financial training. So join us at the June retreat or get an unbiased second opinion from me to start the process so at least you know what you own. You have to be the boss of your money. You cannot have blind faith that somebody else is doing it for you, Because if that is the case, and especially if you're already suffering from paper losses, that is a red flag that maybe you do not have an age appropriate, properly diversified plan. Okay, so we want to know exactly what we own and why, because if we lose money, it's our money. It's not the broker who loses money. So again, I already told you that the S&P lost 19.44, long-term government bonds 26. You can see that long-term corporate bonds did not do well either. And the only thing that really did well in 2022 was silver. Now, Tesla and Arc Innovation, a lot of the most, the large companies did really poorly in 2022. Bitcoin did as well, but they more than made up for it in 2023 and 2024. So here's what an age appropriate, properly diversified plan looks like. If you're 50, 50% should be safe. And again, I do all kinds of blogs. We spend one full day on this at our June retreat about what is safe in a debt world. We are actually overweighting safe because of the possibility for a recession, as well as that everything is very expensive and unsustainably so. And we have unsustainably high debt. So it's a number of reasons why we're overweighting safe. Now, this is key too, because if you're 50 and you're overweighting 20% safe, you have 30% at risk. If 30% loses 19%, you have lost less than 6%, 5.8%. Also, your safe side, if you're doing it right, can earn a 4% return. Now, I'm going to give you some tips about how to do it right. I gave you two big, huge tips: keep the term short and the credit worthiness high, but we're going to also talk about other things that you might want to consider as well. And then you diversify your at-risk in 10 funds: small, medium, large, value and growth, and 4 HOTS. Again, rebalancing once, twice, or 3 times a year, once a year, at least 3 times at most. It's not day trading. It's not constantly watching it go up or down. It's actually a plan that works. So you do that because you get a year older. Also, if stocks go way up, it's saying to you, sell high and trim it back to where the slice should be. If the stocks go down, you have all that liquidity because you captured gains the year before, and it's saying buy more at a lower price, right? This is a plan that really works well. So, are you suffering from paper losses, illiquid investments, or a lower yield than you expected? And this is just bond basics. When interest rates rise, the value of the bond goes down, and vice versa. If cutting rates increases bond value, if there aren't other challenges. Now, again, the reason that bonds lost, especially those long-term government bonds, lost so much in 2022 is because of the rapid rate hikes that we had. So interest rates were rapidly going up, and the existing value of bonds that were at that lower interest rate were going down. They were plunging, as you can see, more than even stocks. Now, interest rates are tricky because if inflation remains sticky, the Federal Reserve Board does not want to cut them because they need rates to be restrictive in order to fight inflation. But if we start seeing a lot of unemployment or other weakness in the economy, then they are going to want to cut rates to boost growth. If we have both happening, they have to weigh which one is the bigger risk. So that is why it is a question mark. They are meeting next week, and they are not expected to do anything. They're expected to pause on interest rates. And there could be 1 or 2 rate cuts later this year, but it's not expected to go down anywhere close to where it was in 2020. So tariffs increase costs, that affects inflation. Inflation issues could keep interest rates high. And what that means is the safe side is going to remain tricky. Again, if you have this simple strategy in place, those people that have been, following our bond strategy, the safe strategy, they are doing great. We'll tell you a little bit more about some of the things we did as early as 2010, 2011. But today, people are not suffering from paper losses, keeping the term short and the credit worthiness high. The financial stability report is something I read it. You don't have to read it, but it is a better idea than trying to watch CNBC or read the Wall Street Journal. Starting to learn the data sources from exactly the people that are responsible for our economy can be very helpful. And this is a very troubling report. So we are living in a debt world. We have low credit quality, we have long-term bonds, and that's what adds up to paper losses. I'm happy to email you troubling indicators of asset and debt bubbles, this sheet that we put together from these data sources. Just email info@nataliepace.com. So I already told you that over half of the S&P 500 companies are at or near junk bond status. So companies that were founded last century, 20th century, 50 to 100 years ago, are more likely to have lower credit ratings and much higher debt. The interesting thing here is that a lot of people say, well, who loans them money? And we do. We loan them money in our bond funds, in our managed wealth plans, in our insurance plans, in our bank accounts. So again, this is something that we need to be aware of, right? We're the person who's been loaning money. So we need to be the boss of our money and loan them to, if someone asked you for a loan, you'd want to make sure that they were going to pay it back. There are two other things that you want to think about. One that's very relevant today, never reach for yield. And the other one is a quote I like to use from Will Rogers. And he says, I am more concerned with the return of my money than the return on my money. And in a debt world, this is really important thing to consider. So conservative investors, if they have a managed plan, are being put into illiquid, high-risk private placements that suffer from paper losses the minute they are purchased. So you have to read the fine print. You have to subtract the fees from the expected return. You have to understand that illiquid, high-risk investments can lose money, and you may not be able to get rid of them without even more substantial losses. So you have to, again, know this before you're placed into it. So if your financial advisor can do whatever they want, now is the time to get a second opinion and make sure that what they're doing is in your best interests. And perhaps it is time for you to take more control. So I'm going to find this real quickly. I'm going to pause for 1 second. I'll come right back. Okay, I wanted to show you one of the offerings that one of my private clients was sold into without his, well, he knew about it, but I think that it wasn't represented to him the full picture. And let me show you what I mean by that. So the first thing is that this particular investment, I want you to read number 5, will generally invest in securities or loans rated below investment grade or not rated, which should be considered to have speculative characteristics. That means they are junk bonds, right? You're loaning to someone who doesn't have a good credit rating. So when I say keep the term short and credit worthiness high, this is low credit worthiness. So low credit quality is something I would not be having myself sold into, especially if I'm a conservative investor, which this particular person is. The other one, keep the term short. Well, in this particular fund, once you buy it, you may not be able to have access to your money. And it says that in the fine print as well, that you need to understand that this is something that you're not going to be able to withdraw necessarily. Maybe 5% of the people who buy it is in what's called illiquid. There's not a lot of buyers across the table once you own it. So really important that these two things, and that's one very stark example of how even if you said, I want a steady income, but I'm really conservative, I want to make sure I don't lose money, that you can be sold into something that has a higher likelihood of losing money, restricts your access to capital. So remember to be the boss and to understand what you own now and going forward to read the fine print. Also, again, subtract the fees from the expected return, and that also subtract the paper losses. So this particular person as well, his financial advisor said, hey, you're earning 5 to 7% income. And if you look at the income only, that would be true. But on that same exact statement, it actually showed what the actual ROI was. And the ROI, when you take away the expenses as well as the paper losses, was less than 2%. It stated that right on the broker statement. So that even though the financial advisor was saying 5 to 7, the actual statement he was receiving said less than 2, but he was relying on blind faith instead of reading the fine print. So also another area we're seeing of distress, which spills over into banks and insurance companies, which spills over into annuities and life insurance. Macerich gave Santa Monica Place back to the lender. WeWork went bankrupt. HPP is hanging on by a thread. NYC REIT is almost bankrupt. So again, one of the things that I wanted to show you is that we can have a REIT like HPP had a 9% dividend just last year. And then of course it got cut to nothing. It got a downgrade. It's in trouble. It's on the ropes. It was worth 10 times what it's worth right now. So at the 52-week high. So again, these are all REITs that are either really in trouble, low credit quality. So BBB is the lowest rung. BB is junk, 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 and of course we work bankrupt. So really important that we are understanding this and underweighting. You think, oh, well, real estate is at an all-time high, but you have to know exactly what kind of real estate you're getting involved in and be very, very careful of private placement REITs because they pay very high commissions to your broker salesmen to sell them to you. And they sell them as safe even though they're very high risk, non-liquid, not a lot of buyers on the other side, you may not be able to get your money back easily. And many of them suffer paper losses immediately, and they're very high risk. They might be below investment grade. Because why would they be offering you that high dividend if they could just go to a bank and borrow money? Okay. So these are, again, this may seem like a lot to keep track of, but the truth of the matter is that it's a lot easier to just have that pie chart and just keep, and okay, so what is an example of keeping the term short and the credit worthiness high? Know the credit worthiness of a bank and get a 2-year certificate of deposit that's paying you about 4%. Or have rolling maturity dates on some 2-year US Treasury bills, or if you're in Canada, Canadian Treasury bills. Observe FDIC insured levels. Don't put all of your eggs in one bank. We'll be talking about that more, but I wanted to go ahead and seed the ground with a few solutions. So on the at-risk side, 10 funds, diversified. On the safe side, keep the term short and the credit worthiness high, rolling maturity dates. It's not that hard. Rebalance once a year. Know what you own now, though, because you want to fix the roof while the sun is still shining. If you wait for the headlines, you're going to have lost a lot of money. And at that point, it might be better to hope and pray that you crawl back to even. It's far better to fix the roof while the sun is still shining and protect your wealth. So I'm going to be showing you a slide of, simple, office administrator and her husband who's a handyman. And they came to me, I drew a pie chart on a napkin. They used that, they followed it. And in the Great Recession, they earned money instead of losing more than half, which is what most people lost, and then had to wait 5.5 years to crawl back to even. So this is a picture I took of the former Google campus, which is bought by UCLA for, far less than HPP had paid for it. And it will now be a UCLA research center. Again, we talked about these dividend REITs, and here was Hudson Pacific with that 9% yield before. So there are risks of the following fixed income products that could result in real losses in a debt world. So private loans, real estate investment trusts, money market funds, believe it or not, annuities, keep long-term anything, low credit quality, uninsured bank deposits, bank sweeps at brokerages, and even treasury bills. Now we're going to talk about them, right? Private loans and equity can be illiquid, high fees, and might be junk, so not investment grade, low credit quality. Same thing for real estate investment trusts, but it's really like if you have been walking around your neighborhood, all of those for lease signs or your mall, or you've been noticing that there still are a lot of people who are working remotely, right? So half empty office buildings, the malls are more than half empty. Even many malls are having trouble renting out office space. Everybody's working from home. Money market funds are vulnerable to runs. They are not FDIC insured, and they almost always get into trouble in recessions. Now, they usually do get bailed out, but again, that can be very stressful. Also, if interest rates do get cut, the yield that you earn on them goes down. So I think many brokerages will allow you to purchase FDIC insured certificates of deposit or treasury bills. So I would look at that, not a treasury bill bond fund or, anything like that. I would look at purchasing the actual asset. So long term, again, you're going to have illiquid paper losses. The companies or the entity could restructure. Low credit quality, same thing. Uninsured bank deposits. So I would it's really a pain, but I would definitely observe on the federal insured levels of banks. And I would also be observing which banks have the higher credit scores, right? Because it's stressful to go through FDIC a seizure of your bank. And if you have uninsured deposits above the federal insurance level, that is very stressful. And it's not guaranteed that you get bailed out on that one. So I think it's pretty important to do that. Again, if you would like an unbiased second opinion, I offer that through private coaching. Just email info@nataliepace.com. Bank sweeps at brokerages. Brokerages are actually not FDIC insured if they fail, right? So they're saying, hey, we have a relationship with a bank, and if that bank fails and it's under FDIC, that's okay. But if the brokerage fails, not. And we have seen that problem, okay, mostly in crypto brokerages, but it's something that it's become so prevalent that a lot of brokerages now have that in their fine print. So even treasury bills, and I'm going to talk about that because we're starting to see a little more stress in the treasury market. We saw a lot of stress in the UK treasury market, and I think we have to be aware of that, both what happened and then how it's no longer a big issue right now, but it's still something that could be a phantom in the wings. So these are the risks that have been cited by the various survey participants of the Federal Reserve Bank. So most of them are saying that the potential shocks, and what a shock is something that would cause the stock market to plunge, basically, right? The economy goes down, we might hit a recession, and stock values might go down. And stock values right now are very high, so they tend to go down farther and faster in that scenario. So global trade, policy uncertainty, debt, inflation, that we might actually have to have interest rates go up. Valuations, that means just what I said, that stocks are high, real estate is high. And then now we've got treasury market functioning. So that's been becoming more of an issue, and the US might hit a recession. Banking stress, right? So all of these things, they are basically pointing us to observing federal insurance levels, keeping the creditworthiness high, rolling maturity dates, short term. So all of the things that we're talking about, and it's not that difficult to do. You just have to know how to do it and where to do it. Again, I'm not going to be able to teach you every aspect of that in a half hour like we're having now for this free video conference. We spend one full day on it at the Financial Freedom Retreat. Just go to nataliepace.com. The next one is June 6th through the 8th. It's online. You can attend from anywhere. On the 8th is when we'll spend one full day on what's safe. And there are lots of different things that are safe that can be exciting to think about. So many bonds are at risk of being negative yielding and illiquid. That means we can lose money and be stuck with them. So again, it might be interesting to you. What liquidity means is there somebody across the table that will want to buy that from you? So let's say you buy something and it suffers paper losses and you say, you know what? I don't really want to own that anyway. I'm going to buy a house instead, or whatever it is that you're going to do. You have to be able to sell it in order to get the money back before the term. Like, especially if it's, I've seen people that have 85 years. They're sold into this without even knowing it. And one person, it was a junk bond. So you're going to have to sell it unless you want to wait until, you're in the funeral home for 85 years. So that there has to be somebody that wants to buy it. Now, if they think it's junk, right, they might say, I'll give you a little bit less for it. So you're going to lose money on that if you can sell it at all. And that's what being illiquid means. So is there somebody that will want to buy it from you? So if you have S&P 500 stocks, lots of buyers. Look at that. Dow Jones Industrial Average stocks, not anywhere close to as many. If you have gold, lots of buyers. US T-bills, pretty strong, but I'm going to show you something a lot stronger US T-bills in before the pandemic than it is right now. So it has gone down a little bit. And also, you see corporate bonds. Oh man, those are really illiquid. Not a lot of buyers across the table. German treasuries and UK treasuries, even less liquid than the US corporate bonds. So bond funds are losing a lot of money. Investment grade bond funds can have junk bonds and commercial real estate and mortgage-backed securities in them. So again, here was last year's return. You saw government bonds lost again last year. They didn't really get anything in 2023, and then they were huge losers in 2022. The safe side of our nest egg is where we're supposed to stay strong. So again, here was the bond performance in the Great Recession when stocks lost more than half. That's how Nilo earned gains when most people lost more than half. So legacy debt, low credit quality, persistent inflation versus job losses, that means it is a question mark whether or not interest rates are going up or down. They're very high risk long-term old debt and paper losses versus short-term reasonable yield, lower risk new debt. Navigating between requires research and wisdom, and by the way, it's easier than you know, right? It's much easier. Now, even after this, you're starting to become aware of things that you might not have known before. And this is just a reminder, this is a sample pie chart we had in 2012. We were overweighting safe. There were reasons for that. But we were encouraging people at that time. Look, we said, look, bonds and bond funds are vulnerable, right? So why not go for a safe income producing hard asset like income property? And of course, real estate has more than doubled. So again, there's always some low-hanging fruit. There's always some risk. And when we can underweight risk, and lean into low-hanging fruit in an age-appropriate, properly diversified plan, that's going to be the best performance that we could possibly have. So as you can see, over the 10 years, long-term government bonds did in fact go down. And again, we've been saying for over 10 years, these are a problem, and real estate went crazy. And we were saying, try this instead. Real estate is too high to just go buy real estate right now. So I am hosting a real estate masterclass the Saturday after our June retreat. That's on June 14th. If you'd like to know that, there are areas of opportunity, but it's not found on the multiple listing services. That's the 30-year performance. You're welcome to take a picture of it. So again, we have paper losses, duration risk, credit risk, liquidity risk, yield versus cost risk. That's a lot of risk for the side of our portfolio that is not supposed to lose money. And again, there are solutions, and they are easier than you know, but you must know them, because if you don't, then you might be suffering from paper losses. And if you are, they are more problematic than you are being told. And if the economy weakens, they become even a bigger problem. because then we can have a lot more restructuring, which means the value of your bond goes down even further. So this is what I wanted to show you is that short-term bonds that are pretty good credit quality are paying a similar yield as those very risky paper loss long-term bonds. So if you look here, the one-year rate on treasuries, the par year rate was almost 4%, and the 30-year term is 4.7%. So again, don't reach for yield. I've already told you this. Keep the term short and the creditworthiness high. Think outside the box, diversify. Don't put all your eggs in one bank. Observe FDIC or in Canada, CDIC or whatever country you're in, the federal insurance levels. Now, this is what I wanted to talk about, the guilt crisis. So I think that Prime Minister Truss was one of the shortest terms of any prime minister. And so she had a budget that went into play, and then the Treasury market froze up. And it was a huge problem. She got the boot, and the Bank of England started buying up treasuries, and that's how they got out of it. But you're seeing from the liquidity data that was just from May, I mean, just from, sorry, from March, that is still very thinly traded market. There's not a lot of people that are buying UK gilts. More people are buying US treasuries right now. It's still well functioning, but that's what will happen if it starts freezing up, is that the Federal Reserve Bank will start buying it again. So again, credit worthiness, the US and Canada AA plus, and this is by Fitch, and Australia's AAA. Now, this is something that we're doing. If you notice on our value funds, we were doing value replacements because we were trying to find countries that had maybe higher credit quality, like Australia, and even higher yield. So you're getting almost double the yield by going into an Australia fund and slightly higher credit quality. So we are looking at certain things to do that in our portfolio as well. It's just a little finesse. You don't have to do it if you just had small, medium, large value growth, 10 funds, age appropriate, properly diversified, and especially if you're overweighting a little more safe, you're going to do well in the next downturn. You must know what's safe in a debt world. And again, one full day on that too at the retreat, or get that second opinion. But do it now. Don't wait until the market bottom. Also, there are other opportunities. Every bill you eliminate could be the best yield in a debt world. So is solar right for you? Do you live in a sunny state? There is a 30% tax credit in the United States for solar and energy efficiency upgrades. An 18,000 solar panel could bring in a 24% yield or higher after the payback. So this is something to think about. Electric cars can save half or more on gasoline costs. So yield is back, but it is tricky. You want to rebalance regularly. The nest egg pie chart system with regular rebalancing earned gains in the dot-com and the Great Recession and outperformed the bull markets in between. So know exactly what you own and why, and don't have blind faith that somebody else is protecting you. So again, here's a pie chart if you're 30. And here's one if you're 50, and you can see that we do have value replacements, a little finesse, because value is where there is those older, heavily indebted companies, especially in the US. In Australia, their debt to GDP is far lower than the United States. So now is the time to make sure that you are the boss of your money. Adopt an age-appropriate, properly diversified plan. Consider overweighting a little more safe. Conduct a forensic examination of your current holdings. Consider getting an unbiased second opinion. Know exactly what you own and why. Underweight risky, illiquid assets. Do the math on high yield. And always include the fees and paper losses, because oftentimes that high yield, which isn't really that high to start off with, is not a high yield when you consider the expenses and the potential paper losses. This is Bill and Nilo, the couple I told you about. I charted a simple plan on a napkin, and they earned gains when most people lost half of their wealth. My strategies were first enthusiastically recommended by Gary Becker. He's a Nobel Prize winning economist. And that was back in 2006. And these are now time proven 21st century strategies. So again, things have gone well so far, unless you consider the five banks that failed in 2023, housing unaffordable, interstellar debt lows, the lowest personal savings rate in history, massive leverage. And again, all of this is really reflected in the Financial Stability Report, which you probably haven't read and you may not have even heard much about in the news. So again, in the fixed income products, take a picture of this. And it's not like you can just buy and hope, and when things go down, just hope and pray because your FICO score is plunged, your wealth is plunged. It may put you in stress over bill paying. It may change your life in a negative way. We saw that in spades in the Great Recession. 20 million homes were lost in the Great Recession, and that means foreclosures, plunged FICO scores. It could take a decade to recover from that. It's better to protect yourself and fix the roof while the sun is shining. It's human nature to wait until something breaks before you fix it, but I'm encouraging you to fix it now while the sun is shining. So capital preservation allows us to buy low. Most people don't buy low because they can't. They lose too much in the recession and then they're struggling and fighting with banks and other debt collectors. So these are all the things that I've already told you. And we spend one full day on what's safe. You can find a yield of 4% or higher. You can start evaluating what you already own. You can discover why laddering and liquidity are important. Adopt the mindset of families that retain wealth over the centuries. Be the boss of your money. That's the retreat. That is our personalized, you can personalize your own sample pie chart with our free web apps. Just email info@nataliepace.com and we'll send you the links for that. So again, here's nataliepace.com. There's the links for the books. Scroll down, you'll see the link for the upcoming June retreat online. You can attend from anywhere. Go to the menu. You'll see I'm hosting a stock masterclass this Saturday. I'm hosting a real estate masterclass on June 14th, and you can see other opportunities there as well. So thank you for joining me today, and you can share this with your friends. It's free. I also encourage you to follow me on social media. You'll have daily money tips there and join our email list. I try to limit emails to once or twice a week unless there's something major happening that you need to know about. Look, email is not that reliable, so it is important to follow me on social media as well. And there again, I do try to do daily money tips. So you can follow me on Instagram. There's all the links right there that you can use. There's Facebook, X, Instagram, LinkedIn, email, our podcast. Also, you can go to Substack if you want to listen to this instead, and there's the YouTube channel. So thank you again for joining me. I look forward to seeing you June 6th through the 8th online or this Saturday for our Stock Masterclass.